Welcome to PIMCO Pod. In this episode, we discuss how geopolitical tensions and disrupted shipping routes are intensifying energy market risks and weighing on the global economy. Stay tuned after the conclusion of the podcast for additional important information. Geography, geopolitics, and gamesmanship leave little room for error in energy markets. By Tiffany Wilding and Greg Chernow. Energy markets have reached a precarious moment, with the path of prices over the remainder of the year and potentially beyond hinging on two key questions. The first major concern is the direct hit to energy assets, as we have already seen with attacks on facilities in Qatar, for example. In addition to the Persian Gulf, risks also emanate from escalating reciprocal attacks between Ukraine and Russia. Successful strikes on infrastructure lock in supply losses for a potentially extended period, straining global balances. The second critical concern is how long shipping disruptions last, which depends on the course of negotiations between the U.S. and Iran and whether either party achieves a decisive outcome. As the earlier ceasefire showed, output began to recover as shipping resumed, but the losses remained substantial. Renewed threats to shipping in the Red Sea complicate the equation. Put simply, the current state of affairs in the Middle East, Ukraine, and Russia is not sustainable, with each passing week imposing incremental strain on supply, even as tensions escalate or de-escalate on any given day. As we argued in macro signposts on April 1st, 2026, without a normalization in the free flow of trade through the world's waterways, markets will eventually need to contend with greater global recession risks and demand destruction that could weigh on equity and credit markets. Leaders in the regions involved in these conflicts are well aware of the impact on energy markets. In the end, geography, geopolitics, and gamesmanship could determine a lot about the future of energy supplies and energy prices, and their economic consequences. Unlike in March, when the Strait of Hormuz was the main focus, energy supply risks now span three key geographical points. The Persian Gulf remains the epicenter. The path of hostilities in the Persian Gulf remains first on the list of concerns. After a brief, constrained reopening of the Strait of Hormuz following the ceasefire, shipping through the strait is again at a near standstill. Without shipping, production is effectively limited to what can be consumed locally or piped across Saudi Arabia to the Red Sea or across the United Arab Emirates into the Gulf of Oman. The U.S. maintains a blockade on Iranian exports, while Iran is asserting control of the strait as the new status quo, whether for economic rent or strategic defense. Cumulative oil supply losses to date exceed 1 billion barrels, now the largest net loss of energy supply in history. With dozens of ships attacked, insurance costs have surged, and the pool of owners willing to risk crews and hulls in the strait has shrunk. The situation is fluid, but supply from a region that provides nearly 20% of global oil must eventually normalize, or the global economy will have to adjust. All data are from the International Energy Agency, IEA, with PIMCO calculations. A second front in the Red Sea. Saudi Arabia's rerouting of 4 million to 5 million barrels per day to the Red Sea in response to the Strait of Hormuz closures, according to Kepler, has been a critical lifeline for the oil market. Thus, the Houthis' renewed attacks on Saudi shipping and infrastructure in the Red Sea escalate the risk that Saudi oil supplies can't make their way out of the Middle East. History shows the Houthis can meaningfully disrupt traffic through the Red Sea's Bab el-Mandeb Strait to the south, with less impact on northern flows through the Suez Canal to the Mediterranean. If the issue is largely confined to Saudi vessels through this strait, while other ships pass, the impact is more logistical than fundamental. Asia's dependence on Saudi barrels moving through Bab el-Mandeb could be reduced by rerouting ships north. That is taxing, but not a net supply loss. The calculus changes considerably if the Houthis continue to strike Saudi export infrastructure, prevent ships from docking, meaningfully block all traffic through Bab el-Mandeb, or hit the pipelines running from the eastern producing basins to the Red Sea. The situation remains tenuous. Russia-Ukraine attacks tighten the product market. The third critical geography is the escalating Ukrainian campaign against Russian shipping, refining, and now export ports. The reach and efficacy of these strikes deep into Russia have been significant, and the costs to the oil market are adding up. Russian refining has been impaired for months, dropping processing to its lowest level in over 20 years, according to the IEA. Russia, normally a major exporter of refined products, particularly diesel, has not only cut exports, but also been seen buying gasoline cargoes to replace lost domestic supply. Combined with reduced product exports from the Middle East, this has driven diesel, jet fuel, and gasoline to record premiums over crude. More recently, Ukraine has stepped up attacks in the Sea of Azov and Black Sea, disrupting both energy and critical grain flows. Strikes on the port of Novorossiysk, where several ships were hit by unmanned surface vessels, USVs, have curtailed exports of critical Kazakh oil. The port had been loading roughly 2% of global supply before the attacks, according to the IEA, which would be a non-trivial loss even in the best of times. The squeeze is in products and natural gas, not just crude. The problem facing the global economy is not limited to crude oil. Refined products, petrol, diesel, and jet fuel sit at record price premiums to crude, reflecting genuine supply chain constraints. Even with crude nearly 30% off its year-to-date peak, refined products as of this writing are within a few percentage points of year-to-date highs, pushing U.S. retail gasoline above $4 per gallon and diesel above $5 per gallon, according to Bloomberg and the American Automobile Association. Higher prices for refined products can significantly damage activity because roughly 2/3 of world oil output goes to transportation, and Middle Eastern crude is refined disproportionately into the middle, distillates, diesel, jet fuel, shipping fuel, on which Asia, Africa, and industry depend. Shortages translate quickly into reduced deliveries, stranded cargoes, and broader supply chain and food price pressures via diesel and fertilizer. The Persian Gulf is also a critical supplier of liquefied natural gas, LNG, and global gas prices as of this writing have climbed to their highest since Russia's invasion of Ukraine. A particular problem because outside the U.S., inventories are on track to enter winter with the thinnest storage coverage in over a decade. The buffers are largely exhausted. Crucially, many of the shock absorbers that cushioned the early stages of the U.S.-Iran conflict are now depleted. Strategic petroleum reserves globally have already released some 300 million barrels, offsetting almost a third of the global supply loss, dropping U.S. reserves to their lowest since 1983, when stocks of the Organization for Economic Cooperation and Development were being deliberately built after the oil price shocks of the 1970s, data according to the IEA. Commercial inventories have also drawn down, taking stocks of key refined products to multi-decade lows. System flexibility is far lower today than earlier in the year, and unlike then, we are heading into harvest, pre-holiday stockpiling, and the tail of the summer travel season. The room for error is minute. The China wildcard. One major surprise has been how far and fast China cut crude imports. The world's largest importer nearly halved purchases through a mix of demand reduction, inventory withdrawals, and lower product exports, the last of which only worsened the global product shortage. Drawing on inventories built up in prior years, China has bought itself flexibility, but the open question is how long it will keep imports constrained. Never has a demand source of this scale adjusted by this magnitude. The timing and pace of the demand recovery and ultimate restocking complicate views on second half of 2026 and 2027 balances. Should China maintain its current import levels, crude oil prices will likely face less upward pressure. Should China re-enter the market and begin restocking, oil supplies would need to ramp up to match, or shortages will emerge outside of China. What it means for the global economy. This is, at its core, a stagflationary supply shock. It lifts headline inflation broadly while weighing on activity. Higher real energy prices act as a tax on consumers of oil and energy products, while a large global disruption in oil supplies would necessitate lower demand. How smoothly that adjustment happens is a key question for markets. As we learned during the pandemic, seemingly small disruptions can reverberate through global supply chains. Regionally, the growth hit falls hardest on net energy importers: Europe, the UK, Japan, and much of Asia. What is unique to this episode is how the AI-driven surge in demand for energy and for energy-intensive products, memory and chips, could compound the market disruption. Monetary and fiscal tools have limited ability to offset a sustained energy shock. Central banks are constrained by inflation and the need to keep expectations anchored, while government policies, including price caps and similar demand supports, can be counterproductive, since in a genuine shortfall, prices must rise enough to clear the market, and blunting that mechanism in one region only pushes the global price higher. Thus far, financial conditions haven't tightened very much, as higher rates have been cushioned by a lower equity risk premium. But this is precisely why markets remain vulnerable to a sharp, non-linear tightening if pricing shifts toward a more prolonged disruption. Bottom line. Earlier in our careers, oil supply balances swinging perhaps a few 100,000 barrels a day were enough to move prices and shape conclusions. Today, the number of line items carrying several million barrel uncertainty is surreal, with meaningful and heavily upside-skewed price implications if supply does not normalize. It is precisely these pricing pressures that many are counting on to push the U.S. toward a resolution of the Iran conflict. However, given the lack of trust and the competing, often non-intersecting interests of the parties, a solution is hard to bank on. For investors, hedging commodity risk through a commodity index may make sense. Commodity indices can help diversify portfolio risk and potentially enhance returns. And given the attractive carry on commodity indices today, for example, 6% on the Bloomberg Commodity Index as of July 23, 2026, the hurdle investors must clear to consider holding that exposure is meaningfully lower. Thank you for listening. That was Geography, Geopolitics, and Gamesmanship Leave Little Room for Error in Energy Markets. For future insights, please follow us on your favorite podcast platform. Macro Signposts highlights weekly takeaways from the data analysis conducted by our team of economists and other macro experts. For PIMCO's official views on the global economy, please visit PIMCO.com. This episode uses an AI-generated voice. The discussion and content provided within this podcast is intended for informational purposes only and may not be appropriate for all investors. Reliance upon information provided in a podcast is at the sole responsibility of the listener. The information included herein is not based on any particularized financial situation or need and is not intended to be and should not be construed as a forecast, research, investment advice, or a recommendation for any specific PIMCO or other security, strategy, product, or service. Past performance is not a guarantee of future results. All investments contain risk and may lose value. Investors should speak to their financial advisors regarding the investment mix that may be right for them based on their financial situation and investment objective. Podcasts may involve discussions with non-PIMCO personnel, and such content contain the current opinions of the speaker, but not necessarily those of PIMCO. Other podcasts may consist of audio recording of an existing PIMCO article, and such material contains the current opinions of the manager. The opinions expressed in all podcasts are subject to change without notice. Information contained herein has been obtained from sources believed to be reliable, but not guaranteed. PIMCO, as a general matter, provides services to qualified institutions, financial intermediaries, and institutional investors. This is not an offer to any person in any jurisdiction where unlawful or unauthorized. For additional important information, go to www.pimco.com/gbl/en/general/legal-pages/podcast-disclosures.